Good morning, everyone. So today we are going to talk about the bond redemption, or we can say it like buy back the bond. So try to understand what is the meaning of bond redemption and why it is important. First, let me explain why we sell bond actually, why we issue a bond. Follow me. Why we issue or sell a bond. So this is the first things you should remember. Why do we issue or sell a bond? Okay. Because why you sell a bond? What is the reason? Because we need money, right? We need money to do our business, right? We don't have money. Follow me just. So why we sell a bond? Because we need money, right? We need money. So because of this reason, we sell a bond. Now, when we sell a bond, we receive cash. We receive cash and we record bonds payable. So we need money, so we sell our bond and we record cash and we record bonds payable. So here bonds payable is our liability. Bonds payable is our liability, right? And when we issue the bond, we also pay interest expense. We also pay interest expense. And this is our expense. This is our expense. So if it is a 5 years bond, what we are doing every year, okay, every year we record interest expense. Every year we record interest expense, right? And we carry liability. We carry every year. So we need money, so we sell a bond. After selling bond, we receive cash. Cash we receive, in one sense, it is a good news, your asset increase, but at the same time, our liability increase, right? And as we carry liability every year, it means that this is a long-term bond. This is long-term. Our long-term liability. So if our bond term is 5 years, then we have to carry this liability 5 years. If it is 20 years, we have to carry this liability 20 years, right? And every year we have to pay the interest expense, right? So when we prepare the company's balance sheet or income statement, we record interest expense, right, under the income statement. And we record long-term liability under balance sheet. So you know this information, right? You know this information. So bonds payable is the liability. As it is a long-term liability, we carry our liability every year under the balance sheet. And every year we are going to pay them interest expense. We record it under income statement. So if we record interest expense, our net income will increase or decrease. If we record interest expense every year, okay, it will affect our net income, right? So because of this interest expense, our net income will increase or decrease. If your expense increase, net income will decrease, right? Net income will decrease. So net income net income decrease. So you can see that this net income decrease is a good news or bad news for the company? Bad news, right? Yes, bad news. Bad news. And if it is a 10 years bond, every year, this is your bad news, right? Then in your balance sheet, you are showing a liability, right? In the balance sheet, we have three components. We have asset, we have liabilities, and we have equity. So liability is a good news or bad news for the company? Bad news, right? Liability is a bad news. Liability is a bad news. Good. So we find that if we issue bond, one good news is today you receive cash. So this is the one good news. One good news that you receive cash, right? But we have another bad news like liability, long-term liability, and interest expense. So what we do actually here? So this kind of bad news, if you have more bad news, it is the bad impact for your company, right? Bad impact for the company. So for example, today you sell bond, you issue bond, for example, year 2020, for example. You issue bond year 2020, and for a maturity date maybe 2025, for example. Okay, so the maturity date is 2025. So up to 5 years, you have to show the bad news, liability, and the income interest expense. Now today you do not have money, but maybe year 2023, suddenly you have a lot of money. Okay, so you issue bond for how many years? 5 years. You issue bond up to 2025, right? But when 2023 came, you find that now you have a lot of money anyway. Your business have a lot of money. So if you have a lot of money, what you can do? So you don't need now other people money because you already have money, right? As you already have money, you don't need other people money because this cash is other people money actually, right? This cash is other people money. Now what you can do in the year 2023, you can buy back your bond. Do you understand? You said that you don't want to continue your bond up to 2025 because now you have available money. Now you have available money. You don't want to continue your bond up to 2025, right? So in the year 2023, you want to buy back. You want to buy back the bond. So if you buy back the bond in 2023, so what is the related information here? If you want to buy back the bond, if you want to buy back the bond, that means you can close liability, right? You buy back the bond, you close your liability. Then no need to pay interest expense. No need to pay. If you buy back the bond, you no need to pay any interest expense. Okay. Now, if you buy back the bond, these two information is a good news or bad news? Good news, right? You close your liability. You don't have any liability, for example, bond. So this is a good news. Your good news is you are not going to continue your liability. And another good news is if you do not record interest expense, okay, if you do not record interest expense, net income will increase. Net income will increase, right? Net income will increase. And we know that at the maturity date, we have to return back the face amount, right? At the maturity date, we need to return back the face amount. But if you pay before the maturity date, okay? If you pay before the maturity date, you have to pay cash. You have to pay cash, right? This cash is the carrying amount of the bond. Carrying amount of bond. That means every year we have different carrying value, right? Every year we have different carrying value. So whenever we are going to pay cash in the year 2023, then we are going to pay actually the carrying value, right? Carrying value, something like this. This is the case. So why we go for redemption of bond or buy back a bond? Because this is the good news and bad news that are related with a bond. If we have bond, it means that we don't have money. We are using other people's money. As we are using other people's money, it means that we are going to carry our liability every year, and we are going to record interest expense every year. All are the bad news. These two are the bad news. Now, if you have available cash, okay, now you don't need to continue your bad news anymore. So we can, if we buy back the bond in the middle of any year, then we can close our liability. We can close our liability and we don't need to pay any interest. We don't need to pay any interest. So these are the good news. And we pay cash about the carrying value. Why carrying value? Because today 2020 is the present value, right? If it is today value, and 5 years later we have another value, right? So every year carrying value is different. Carrying value may be higher, carrying value may be lower. Anyway, so we are going to pay cash as the carrying value amount, something like this. So here we will see that maybe we can pay cash higher than the carrying value, okay? We can pay cash carrying value of the, that means higher of the carrying value, higher carrying value amount of bond, or lower carrying value of the bond. So we are going to pay cash higher of the carrying value or lower of the carrying value. I will show you later on what is this. Something like this. So we can, so when we pay cash, maybe it is higher than the carrying of the bond or lower than the carrying of the bond. It depends on the situation. It depends on the situation. So this is the definition of bond redemption. So a corporation may redeem or buy back or call back bond before they mature. So maturity date may be 2025. Before the maturity date, a company can buy back the bond or call back the bond or redeem the bond. Okay, now look at this diagram. Look at this diagram. So we issue a bond. Today we receive $96,406. And 5 years later, we are going to pay them $100,000. And every year, this is our interest expense. This is the previous class information, right? So this is a premium bond or discount bond. Can you tell me this diagram is a premium bond or the discount bond? Discount bond, right? So today you receive less money, but in future you are going to pay more money, right? So carrying value is increasing or decreasing every year. Can you guess? Yeah, carrying value is increasing, right? Yes. So different year have different carrying value, right? Year at the end of year 1, we have one carrying value. At the end of year 2, you have another carrying value. At the year of 3, we have different carrying value. But at this moment, we know this is the beginning carrying value, right? For $96,406 is the beginning carrying value, and this is the 5 years later carrying value. So, and in the middle, we have different carrying value. Now, maturity date is up to 5 years, but after 2 years later, company decided to buy back the bond. And I already explained what is the benefit if you buy back the bond, right? What is the main benefit? Main benefit, no need to continue your liability, no need to pay interest expense anymore. So if you stop here, look at here. If you stop at the end of year 2, you no need to pay this kind of expense, right? You no need to pay this interest expense. Why? Because you stop here. And you can stop your liability also here. So you will close your liability and you will stop to pay the interest expense. Now, how to do that? How to buy back this bond? How does the journal entries are required? How to handle this kind of accounting issue? So to close the bond or buy back the bond, we have 3 steps. We have 3 steps. First step, close the carrying value of the bond. So we don't know what is the carrying value of the bond. We have to calculate it and we have to close it. Because you can see that every year we have different carrying value. So today's carrying value 96, 5 years later carrying value $100,000. So every year we have different carrying value. So at the end of year 2, we have a carrying value of the bond. We have a carrying value of the bond, so we have to close it. So do you understand? Close means you are going to stop it, right? You are going to stop not to continue your bond, so you have to close the carrying value of the bond. And if you close the carrying value of the bond, you need to pay cash, right? Because you return back my bond, I have to give you money back. So first we are going to close our carrying value. After that, we are going to pay cash, okay? And comparing these two, we may have some gain or loss today. Do you understand? So we close our bond first. That means we close our carrying value. After closing the carrying value, we are going to pay cash. Now, when we pay cash, if you pay more money than the carrying value, then you have a loss. If you pay less money than the carrying value, you have a gain, right? So this information, what is the carrying value of the bond? This information, what is the amount of this information? The buyer of the bond, they don't know this. Only you know this information. So because this is your business, right? This is your business. You only know what is the carrying value. You only know what is the carrying value. But the people who is holding your bond, he or she don't know what is the carrying value. You just request him, please return back my bond. I am going to give you this money. Okay, I am going to give you this money. So the holder of the bond, he or she doesn't know what is the amount of the carrying value. Okay. For example, you told me that please return back my bond. I am going to give you $10,000, something like this. So I may give you more money or I may give you less money because I need to return back my bond. Okay, I need to return back my bond. I can give you some more money than the carrying value, or I can give you some less money than the carrying value. It is my choice. Okay. So if I give you more money, maybe I have a loss today. Okay. If I give you less money, maybe I have a gain. Do you understand? So these 3 steps are involved. These 3 steps are involved for buying back a bond. Okay. Now, how to do that? So how to record, I'm going to show you now. How to record bond redemption. How to record bond redemption. So we can see that we have different steps. Accounts, then normal balance, So try to understand how to handle this. If you remember, when we solve our bond issue at face amount, bond issue at discount, or bond issue at premium, we remember that we have several accounts. One is called bonds payable. Another is called discount on bonds payable. Another is called premium on bonds payable. Can you remember this? When we record our issue of the bond or discount of bond or premium bonds, we have these three accounts, right? We have these three accounts, yes. So this is related with issue of bond, premium of bond, or discount of bonds. So can you remember when we do the journal entries? When we do the journal entries, we record bonds payable debit or credit. When you issue the bond, issue of the bond, can you remember? That means at that day. What is the journal entries at that day? Can you remember? You record bonds payable debit or credit. Can you remember? Yes, so I can close this one, so it will make it easy for you. So when we record bonds payable, we record it credit. Think about this column, this stage. Okay, this stage. So we record bonds payable credit, right? Can you remember? We record discount on bonds payable debit or credit. If you sell a bond with discount, bonds payable debit or credit? Debit, right? Yes, debit. Very good. We record debit. And when we issue bond at a premium, we record bonds premium on bonds payable credit. Right? This is the normal balance when we issue a bond. Now I told you that 2 years later, we want to close, right? We want to close. So if we want to close, it means that we are going to close this account. And we are going to close this account. And for example, I can put a number here. I can put a number like for example, 100,000. This is 500,000, 5,000, and this is maybe 3,000. Yes. So I just put some random number, and we record it credit, right? Record it credit. Now, step one said that close the carrying value of the bond. So this is step one. Step one said that close carrying value of bond. This is step one. Remember step one? This is year two. We are going to close carrying value of the bond, right? So we already recorded when I issue bond, we already recorded bonds payable credit, discount on bonds payable debit, and premium on bonds payable credit. Okay, so this is already recorded. Now we are going to close it. That means we are going to close. It means that we are going to close bonds payable. We are going to close discount on bonds payable, and we are going to close premium on bonds payable. So we are going to close it, right? So if you want to close it, bonds payable should record, look at here, opposite. Before you record credit, right? Before you record credit, you record credit $100,000. Okay. Now you have to record debit $100,000. Do you understand? Before we record credit, look at up to here. Before we record credit $100,000, right? Now, if you want to close it, you have to record debit $100,000. Then this is closed. This account is closed. Why this account is closed? Because before you record credit, right? Now, if you want to close, you record $100,000 debit. So this account becomes zero, right? This account becomes zero. So discount on bonds payable $5,000 debit. Now to close, we have to record credit $5,000. So if you record now credit $5,000, this is closed. Then premium on bonds payable $3,000 credit. To close, we have to record debit. Debit $3,000. So this is step one, how to close carrying value of the bond. Okay, how to close carrying value of the bond. This is the step. Bonds payable now. Okay, bonds payable before you record credit. Now to close, record debit. Discount on bonds payable before you record debit. Now to close, record credit. Premium on bonds payable before you record credit. To close, now debit. Do you understand? Now step two, paid cash. Step two, you are going to pay cash. So we already know which one is debit, which one is credit. Now step two. Step two, paid cash. So if you pay cash, your cash will increase or decrease today? Decrease, right? So cash decrease. And if cash decrease, it is debit or credit? Credit. Credit. So we understand step one. We understand step two. Credit. Now here I told you that when we pay cash, we can pay higher than the carrying amount, right? Or we can pay lower than the carrying amount. Because look at here, if you are the holder of the bond, right? If you holder of the bond, if you hold this bond up to 2020, what is your benefit? You have a benefit. If you do not want to return me, right? If you don't want to return back my bond, and if you hold the bond, your benefit every year you will receive interest, right? Every year you are going to receive interest. So in order to motivate you, sometimes I can give you more, or sometimes I can give you less. Anyway, so step three said that, for example, I write here carrying value of the bond. Okay, for example, carrying value of the bond here is $80,000, for example. And we close it. We close carrying value of the bond means our carrying value of the bond is at this moment, for example, this money, $80,000. And we pay cash. For example, we pay cash. We have two situations. We pay cash $70,000. Carrying value of the bond. Okay. Carrying value of the bond. Carrying value of the bond $80,000, but we pay cash $70,000. So step three is called recognize gain or loss. Recognize gain or loss. So this is step three, recognize gain or loss. So based on this step one and two, compare step 1 and 2, you have a gain or loss. If you compare step 1 and step 2, the carrying value is $80,000. You pay cash $70,000. It is your gain or loss? Gain, right? Gain. That means that carrying value is greater, right? Carrying value is greater, and paid cash is lower. If this is the case, we have a gain, right? We have a gain. And can you remember, we record gain in the debit side or credit side? We record gain in the debit or credit? Debit. Gain is debit. How is it possible? Gain is revenue, one kind of revenue, right? It is credit. Gain is recorded as credit. Now think here. No, we are not going to pay 70,000. We are going to pay 85,000. We are going to pay 85,000. So carrying value is $80,000, but we paid them $85,000. So what is the meaning here? Carrying value is lower, right? Carrying value is lower, and we paid cash higher, right? We paid cash higher. So it is the bad news. It is our loss. Loss. And we loss record in the debit side. We record loss in the debit side. So these are the 3 steps. These are the 3 steps when we record the buyback of the bond. First, I repeat again, we close carrying value of the bond, right? To close carrying value of the bond, this is the formula. This is the formula. Bonds payable before we record credit. Okay, bonds payable before we record credit. To close, make it debit. Okay, to close, make it debit. Discount on bonds payable before we record debit, right? To close, you have to record credit. Premium on bonds payable, we record credit. To close, make it debit. This is step 1. Step 2, we pay cash. Cash always credit, because we pay cash, right? We are not going to receive cash. We are going to pay cash. So cash is always credit here. Now, if carrying value is higher and payment of cash is lower, then we have a gain. And gain is recorded in the credit side. And if carrying value is lower, sorry, carrying value is higher. Sorry, carrying value is higher, right? And here carrying value is greater than. Yeah, here carrying value is lower. Here carrying value is lower and we pay cash higher. So we have a loss. Loss is the debit. Loss is the debit. Now let's see some example. Exercise 1. For example, you are given, I can give you some information. So bonds payable is $100,000, 100,000, okay. Then so you are given these 3 information. Bonds payable $100,000, premium on bonds payable $400. Okay, and you pay cash. $300,000. So what is the journal entry to close this kind of bond? What is the journal entry to close this kind of bond? Do it now yourself first. So what is the journal entry? Can you remember we have to close the carrying value of the bond, right? So carrying value is here. These two items belongs to the carrying value. These two items belongs to the carrying value. So based on this information, you have to calculate carrying value of the bond. So based on these two information, because we are going to compare, can you remember here? We are going to compare carrying value and paid cash, right? To recognize gain or loss. Do you understand? So we need to know what is the carrying value. If you don't know what is the carrying value, you cannot recognize your gain, you cannot recognize your loss. So based on these two information, what is the carrying value of the bond? Based on this information. Okay, based on this information, what is the carrying value of the bond? Anyone? So we calculate carrying value of the bond based on bonds payable, discount on bonds, and premium on bonds, right? Based on this information, we calculate the carrying value of the bond. So what is the amount of carrying value of bond based on these two information? You don't know? No one can explain? You add these two numbers because both are credit, right? Look at here. Both normal balance credit, right? Bonds payable credit and premium also credit. Credit and credit plus, right? Very good, yes. So the carrying value here is, the carrying very good. Carrying value here is, this is the carrying value, right? This is the carrying value. This is the carrying value of the bond. Now we are going to record the bond redemption. We are going to record bond redemption. We know that bonds payable normal balance, okay? Bonds payable normal balance credit here. This is the normal balance. This is the normal balance. This is the normal balance. So bonds payable normal balance credit, right? To close, make it debit. Right here. Bonds payable normal balance credit, to close, make it debit. So bonds payable now debit. Bonds payable debit $100,000. Then premium on bonds payable, we have to close it. Premium on bonds payable. Okay, we write it here first, credit. Premium on bonds payable credit $400. Sorry, debit. Premium on bonds payable debit because it is normal balance is credit. So we close it. So we done our step one. We done our step one. Step one said that close the carrying value of the bond, right? Close the carrying value of the bond means we close bonds payable and we close premium on bonds payable because this question have these two items. This question has these two items, bonds payable and premium on bonds payable. We close it, right? We done step one. What is step two? Step two, we paid cash, right? Step two, we paid cash. So if we paid cash, I told you that it is credit. So in the exam question, in the exam time, you have to follow this style. Debit, when you write credit, you should have some space. If you do not follow this, I will deduct your grade. So first we write debit, then we put some space, then we write credit. So what is the amount of cash we paid? We paid 100. This amount we paid. We paid this amount. Now tell me, we have a gain or loss according to this transaction. Loss. And loss is debit or credit? Loss debit, right? Yes. So loss is debit. So we have to record here loss. Loss on sale of bond redemption. Loss on sale of bond redemption is how much? 2,600. 2,600. So this is the journal entry for bond redemption. Okay, so look at exercise 2. Exercise 2. Bonds payable, again, bonds payable, I can change the number here. $250,000. Discount on bonds payable, $2,000. Cash paid $245,000. No, not carrying value. Cash paid $245,000. So now you have to calculate the carrying value of the bond, right? Carrying value of the bond. So we know that bonds payable normal balance credit, bonds payable normal balance credit, and discount on bonds payable normal balance debit, right? Debit. And what is the relationship between credit and debit? Positive or negative? The relation between debit and credit is negative, right? Because one is debit, another is credit. So we have to do minus. So what is the carrying value of the bond? What is the carrying value of the bond? $248,000 is the carrying value of the bond, right? So carrying value of the bond is $248,000, and you pay cash $245,000. So if we recognize gain or loss, in this situation, we have a gain or loss? Gain. Yeah, so we have a gain, and it is $3,000, right? $3,000 gain. So this, whenever I will give you a question, you have to do this kind of calculation. This is the calculation you should do. This part and this part you should do. Do you understand? So payment cash is given in the question. So bonds payable given in the question, okay? Discount on bond payable or premium on bonds payable given in the question, right? How much cash is paid given on the question. So what you have to do? You have to calculate the carrying of the bond. So why we need to calculate the carrying of the bond? To see whether we have any gain or whether we have any loss, right? Because we have to follow these 3 steps. Now how to record the journal entries? Bonds payable normal balance credit, right? Bonds payable normal balance credit, we have to record it now debit. Okay, we have to record it debit to close. We have to record it debit to close, right? Discount on bonds payable. Discount on bonds payable, normal balance debit. Now to close, make it credit. Right? To close, make it credit. To close, make it credit. So discount on bonds payable, now credit. So we done our step one. Step one is completed. Step one is close the carrying value of the bond. Right? So we close the carrying value. We close the carrying value. Then we pay cash, right? We pay cash credit. We pay cash credit, and we pay cash to $45,000. We pay cash to $45,000, and before we already recognize it is our gain or loss, right? So if it is a gain, okay, gain goes to where? Gain goes to debit side or credit side? Gain is credit, right? Gain is credit. So it is gain on sale of bond redemption, and it is to $3,000. $3,000. So this is the journal entries. This is the journal entries. So if it is a premium bond or discount bond, how to close them? Okay, how to close it? Then exercise 3. Okay, for example, I can write some sentence to make it easy. So on January 1st, ABC company calls. So ABC company calls bond. You can see that on January 1st, ABC company calls bonds with a $20,000 face value. So on January 1st, ABC company call. What is the meaning of calls? Calls means they want to buy back, right? They want to buy back. Calls bond with a $20,000 face value, and remaining the remaining premium on bonds payable. Remaining premium on bonds payable, and the amount is $544. Then ABC company pays cash of $20,000. Pays cash $20,000 to retire this bond. To retire these bonds. Then record now do it by yourself. This is exercise 3. ABC company call back bond. $20,000 is the face amount, and the remaining premium on bonds payable $544. ABC company pays $20,000 cash to retire this bond. So record journal entry. So you can see that this question is about bonds premium, right? It is the premium. It is the premium bond. So how much cash is paid given, right? How much cash is paid given, premium amount given, right? Premium amount given, and what is the face amount of bond given. So all the informations are given. So from here, you have to calculate the carrying value of the bond, right? Carrying value of the bond to compare gain or loss. Anyway, so whenever we solve this question, it is a premium bond. Anyway, bonds payable now debit $20,000. Bonds payable now debit $20,000, right? Then premium on bonds payable to close also debit $544. $544. Premium on bonds payable debit, right? Then we don't know it is our gain or loss. We don't know it is our gain or loss. So we know this information at this moment that the premium on bonds $20,000, $544, bonds payable $20,000. We just close it, right? Step one done. This is step one. And step two, we pay cash how much? We pay cash $20,000. We pay cash $20,000. Now you should calculate the carrying value. After calculating the carrying value, you have to compare how much cash you paid and what is the carrying value of the bond, whether it is a gain or loss. So we have a gain or loss here. Loss, right? We have a loss. So what is the amount of loss? Let me do 56, something like. So 20,000. So we pay cash $20,000. So what is the amount? What is the amount here? You have a gain or loss? How much? Yes, loss on bond redemption. So if I change this question, something like this, so because I can change it something like this, then it is more easy, more clear. So I change the number. 20,600. Loss on sale of bond redemption. So it is now 56, right? $56. Then do exercise 4. Just change the number, 10,000. So new question, exercise 4. Face amount of the bond $10,000, discount on bonds payable $200. Okay, and the company pay cash 10,300 to retire this bond. So record the journal entry. So bonds payable, you can see that bonds payable debit and discount on bonds payable now credit, right? Because discount on bonds payable, normal balance is debit. Normal balance is debit, but to close, make it credit. Discount on bonds payable, normal balance debit, we make it credit now. It is 200. 200. So we have this information. We close our bonds payable, we close our discount on bonds payable, and we pay cash 10,300. 10,300. Now, again, you have to calculate the carrying value of the bond, right? Based on these two information. Based on these two information, you have to calculate the carrying value of the bond, and we are going to compare how much cash we pay. Now we have a gain or loss. Gain or loss. So how it is gain, I don't understand. You pay cash 10,300, right? You pay cash 10,300. You credit discount on bonds payable 200. So why and your face amount is 10,000? How it is a gain? I don't know. It is gain. So we have a loss. Loss on sale of bond redemption. Okay. Now let's do exercise 5. Now we are going to face a little bit challenging question. On June 30, so on June 30, 2020, ABC company calls bond with $100,000 face amount and the remaining discount on bonds payable $4,000. Okay. First assumption. So assume that on June 30, the corporation redeemed 1/4 of these bonds in the market for $24,000. Record journal entry. So this is a little bit challenging. So how to solve this journal entries? So June 30, 2020, ABC company calls bond with $100,000 face value, and the remaining discounts on bonds payable $4,000. Assume that June 30, 2020, the corporation redeems the buyback. Okay, buy back the bond, but not all the bonds they buy back. They buy back 1/4. Okay, 1/4 of these bonds in the market for $24,000. So if this is the case, we have to do some workings, right? We have to do some workings. So this is the total face amount of the bond. All are not going to buy back, right? All are not going to buy back. So times how much they are going to buy back? 25,000, right? 25,000 of the bonds they are going to buy back, not all. According to assumption 1, right? According to assumption 1 said that they buy back the bond, but not all, only 1/4, right? So the face amount, that means this face amount, this is the bonds payable. So the bonds payable is now $25,000, right? Bonds payable is now $25,000. So we have to do another calculation. So discount. So $4,000 is the discount. Again, what we have to do? We have to convert our discount also 1/4, right? We have to convert our discounts also 1/4, and it is $1,000. So this part is called discounts. Discount on bonds payable. Now what is the carrying value? What is the carrying value? What is the carrying value here? 26 or 24? 24,000. Carrying value of the bond is 24,000. Cash paid, how much? How much you cash paid? Also $24,000, right? Also $24,000 cash paid. Gain or loss? How much we have gained or how much we have lost? No gain, no loss, right? Okay. So no gain, no loss. Yes. So you read the question. After reading the question, you find this is the information, right? This is the information. Now we have to follow 3 steps. we have to close this bond, right? That means first you have to close bonds payable. So bonds payable normal balance credit, to close make it debit, right? To close make it debit. How much? 1/4, and 1/4 is $25,000. 1/4 is $25,000. So bonds payable close. We have to close discount on bonds payable. We have to close discount on bonds payable. So discount on bonds payable normal balance is debit, right? To close, make it credit. To close, make it credit. And how much? Discount on bonds payable? $1,000. $1,000, right? And this question said that we do not have any gain, we do not have any loss. So we no need to record this, right? We don't need to record this. And we pay cash. We pay cash credit. We pay cash $24,000. Cash credit. Clear? So this is assumption 1. Now think so this is second assumptions. First assumption. So second assumption said that assume that ABC company calls. Assume that calls the remaining remaining bonds, okay? Calls remaining bonds for 79,500. Remaining bonds for 79,500 on July 1st. Okay, so this is the second assumption. So we'll do workings later on. First, try to understand the question. Assume that ABC company calls remaining bonds. Okay, remaining bonds. So what you have to do? First, tell me. What is the amount of remaining bond? What is the amount of remaining bonds? This is 25,000 already sold, right? So total amount is $100,000. Total amount is $100,000. We already buy back $25,000, right? So remaining is actually $75,000 of bonds remaining. Do you understand? So what is the amount of remaining bonds? Total is $100,000 bond. We buy back 25,000, remaining 75,000, right? Then what is the amount of remaining discount? What is the amount of remaining discount? Total, it was $4,000, right? Total, it was $4,000. 1/4 already sell, right? 1/4 already sell. So 1/4 means 1,000 already sell. So the remaining is 3,000, right? Remaining is 3,000. Remaining is 3,000. It is called discount on bonds payable. Now, what is the carrying value of the bond? 72,000, right? $72,000 is the carrying value of the bond, right? And how much cash we paid? We paid cash 79,500, right? 79,500. So we have a gain or loss. How much? 7,500 is the loss, right? 7,500 is the loss. Yes. So you understand how to do some calculation, right? Now, if we record the journal entry, so we find that bonds payable now debit $75,000. Bonds payable now debit $75,000, right? Discount on bonds payable credit $3,000. Clear? We paid cash how much? We paid cash. This is the money we paid cash, 79,500. 79,500 cash paid, right? So we have a loss, right? Loss is debit. So try to understand. First we write debit, then we write credit, right? Maybe some student will do this. I show you. Maybe some student will do this. Here they write bonds payable debit, right? Then write credit, then again write loss debit. If you do that, I will deduct 50%. Clear? First you have to write debit, then you have to write credit. So the actual system is here. Loss on sale of bond redemption. And it is loss is 7,500. So do you have any question? So this is very important topic for the bond valuation, how to record buy back the bond or the call back the bond.